what to do when we don't have a risk range. There's kind of two questions here. One's geared towards, hey, I've tons of positions in my portfolio. I don't have levels, risk ranges for all of them. What can I do? How can I help? And then secondly is, how do you want us to trade XLE or XLF if there's no published risk range, or ETF Pro risk range? And again, both of these do make sense in regards to, like, I understand why you're asking these questions, but at the same time, it shouldn't prevent you really from being able to execute and make a solid decision, or to curate your portfolio in an appropriate way, right? I mean, although we do trade, we do touch our positions incrementally, almost daily, or most of the time daily. The really where we shine, and the core focus of, I think the best opportunities are trying to capture the full cycle, I guess is the way I'll say that, right? So the risk range itself, I think, is, although important, the trend is the most important thing to be focusing on, right? And there's a saying that we have here that's called "the trend is your friend," and that's I don't think there could be a better way of expressing that. If you kind of jump down two slides, or sort of, I think this is where the out bucket. So I'm going to address kind of the second question first. This is where the out bucket is, at the bottom of the risk range product. This is where things that, had been provided from a risk range standpoint, if they get removed, they go down to the out bucket. I've addressed this before, but at the same time, this is where you can track the trend. And the reason why Keith does this is because, again, the trend is crucially important. Right now, all these out bucket names are bearish trend. So everything from REITs to energy to staples to healthcare to utilities. And again, these will change. So if something moves to bullish trend, let's just say staples, right? And sometime in the future, if they return back to kind of a quad four, traditional quad four portfolio, or sort of in that regard, then it's possible that goes back to bullish trend. Now, at VIX, approaching the F bucket, it's unlikely, but regardless, that what you see there on the screen, or at the bottom of the risk range, that will shift from bearish to bullish when it does do that. So again, this is a good guide, and although you don't have the risk range, you can track the trend itself, and it gives you, I write them down every day. So just, if you're not writing them down every day, I think you're doing yourself a disservice, because you're getting, in this case, 5 extra, tickers in their trends in regards to what they're actually doing. So again, no risk range, but there are different ways that you can try to manage that. Some subs use exponential moving averages to try to gauge sort of trade and trend lines. Other folks use bridge bands, or even have built a version of Keith's VASP signal themselves to help guide them. Now, I haven't done any of those. I don't use any of those components personally. It just I'd rather focus on and track price, volume, and volatility. I think if you can do that and get a good handle on price, volume, volatility for individual pieces of inventory, I think you're going to be making a lot better decisions, regardless of whether or not you've built a signal yourself. So track price across multiple look back windows. I think that's a critically important step. So for me, I use 10-day, 15-day, 21-day, and 63-day look back windows. 21-day and 63-day are basically 1 month and 3 months. So trade and trend, right? So technically trade is 15 days or less, but I do, the machine often works off of a 1 month window. So I kind of keep track of both the 15-day, which would be the trade, and then 21-day to see kind of what the machine and or algos might be doing from a 1 month standpoint. 63 days, as I said, is 3 months, and therefore it's 3 months or more. So I'm tracking it right at that 3 month window. But again, depending on the particular piece of inventory and the volatility levels, my look back window may expand. So something with a lower volatility, like a currency, so kind of call it the dollar, that would go beyond this time frame. So this is, I'd say, more geared towards kind of equities themselves, just as an FYI. just or to clarify. Monitoring volume is also incredibly important on and monitoring in both directions. So on both green and red days, like how's the volume reacting and acting. Volume is volume accelerating on green days, because that typically would be typically a good sign, right? So buyers are stepping in and they're hitting rising offers, right? So that's a good thing. So volume accelerating on red days, though, is a bad thing typically, because sellers unloading shares and they're hitting lower bids, right? So again, this is really important to understand what the volume is doing with the price action, because it really kind of can show you conviction in terms of the market. The last thing to do is to track volatility. And capital, so just flows, are usually attracted to assets with decelerating levels of volatility. You can use realized vol, implied vol, or a combo of the two to help gauge the underlying volatility. And that would be my way in terms of answering question one. When you don't have the risk ranges for individual positions, track those three things: price, volume, volatility, and it's going to help you make a lot better decisions. The other thing you can do from that positioning standpoint, so Jen, I'm sorry, if you can just go back to slide 5 there in terms of that question. They said he's got a lot of different exposure, right? Min position rules, et cetera, et cetera. That's all fine and dandy, and it's good that you're following those rules. But at the same time, if you've got 20 positions, individual securities on at min sizing, that would be, let's just say, it's 50, let's just, for simple math, let's just say it's 1%, right? Is your min size for an individual security. Then, you've got 20% of your portfolio assigned to individual stocks themselves. And typically individual securities or stocks have a higher level of volatility. So you're going to be running a higher level of volatility within your book, right? So I think you just really have to be conscientious as well in terms of like, okay, although you may be following the minimum position sizing rules for the actual like one asset class, what is it when I combine everything together? So ticking, maybe narrowing down some of your positions in it could help. This is where, Keith will rotate his inventory, right? He'll buy some at the low end of the range, sell some at the top end of the range. Again, I know there's questions about, I don't have the risk ranges. So when you are comfortable with kind of making those decisions, rotating and perhaps not having, again, I'm just using 20 as an example, like 20 different individual securities on inside the portfolio. Maybe you've got a watch list of 20 to 50 to 100, but in terms of like what's actually inside your portfolio, you're rotating them in a much more efficient and kind of in a much more risk tolerant or risk management type style. So just wanting to highlight that as well.